It's Thursday, July the 30th, 2026. You're listening to the DX Today AI Daily Brief. Today, Meta's free cash flow falls 91% as AI spending accelerates. Semiconductor shares stage their strongest session in weeks, and a wave of capital lands on the infrastructure and security layers beneath AI agents. Let's get into it.
Meta reported second quarter results after the close on Wednesday, and the number investors fixed on was not revenue. Revenue came in at $60.8 billion, up 28% from a year earlier. Free cash flow fell 91% to $784 million, the lowest in nearly 4 years. Capital expenditures reached $31.1 billion in the quarter alone, roughly double the same period last year. The company narrowed full-year capital spending guidance to a range of $130 to $145 billion. Shares fell close to 10% in after-hours trading. Meta is still growing quickly. It is simply spending faster than it grows.
Microsoft closed its fiscal year Wednesday.
Microsoft ended its 2026 fiscal year Wednesday afternoon with quarterly revenue of roughly $90 billion, up about 18% from a year earlier. Net income was $35.8 billion, and diluted earnings per share came in at $4.81. Executives again pointed to Azure and AI services as the engine, and again fielded questions about how much capital the company is committing to data centers to keep that engine running. The pattern across this earnings season is consistent. Cloud revenue is accelerating. The spending required to serve it is accelerating faster, and the market is now pricing the gap between the two rather than the growth itself.
Amazon reports after the bell today.
Amazon reports second quarter results after the closing bell today, and the questions waiting for it are the ones its peers have already answered badly. Analysts want to know whether Amazon Web Services growth held up and whether the company will raise capital spending guidance the way Alphabet did earlier this month. Amazon is on pace to spend roughly $200 billion on capital expenditures this year, the largest figure of any company in the sector. Together, Amazon, Alphabet, Microsoft, and Meta have disclosed plans for something near $700 billion of capital spending across 2026. The market's tolerance for those numbers has visibly thinned over the past week.
Costs are rising further upstream.
Qualcomm posted third-quarter fiscal results after the close Wednesday, in a quarter shaped less by demand than by cost. The company told customers on July 24th that it would raise chip prices by double-digit percentages on products shipping after September 1st, saying it could no longer absorb rising costs from its own suppliers. That is a notable admission from a company sitting at the center of the mobile and edge AI supply chain. Guidance for the quarter had called for revenue between $9.2 and $10 billion. Price increases at the component layer tend to surface in finished devices 6 to 9 months later, which places these squarely in next spring's hardware.
Chip shares had a session.
Semiconductor shares climbed sharply Thursday, and Intel led them. Intel stock rose about 13%, and Advanced Micro Devices moved a similar distance. Taiwan Semiconductor gained roughly 7%. The iShares Semiconductor Exchange Traded Fund was up about 8.5%, snapping 5 consecutive days of decline. The move followed a stretch of renewed optimism about Intel's position in AI server processors after its most recent quarterly report. It is worth keeping the scale in view. Even after Thursday's advance, the sector's losses across July remain substantial. A single session does not reverse a month, and chip investors have spent this summer learning that lesson repeatedly.
Now to the week's funding.
Elion closed a $145 million Series C on Wednesday at a $1 billion valuation, making it the newest company in AI infrastructure to reach that mark. The round was led by Seligman Ventures, with Cisco Investments and Lumentum joining as strategic backers. Elion builds interconnect technology, the connective tissue that moves data between chiplets inside a package, between chips on a board, and now between racks across a data center using optical links. That last piece is the point. As training clusters grow, the bottleneck has shifted away from how fast a processor computes toward how fast data moves between processors. Ilion is selling directly into that bottleneck.
The data layer drew capital too.
Databarn announced a $40 million Series B this morning, led by Insight Partners, with ForgePoint, GTM Capital, and S3 Ventures also participating. That brings the Texas company's total funding to $59 million. Databarn describes its product as an agentic data control plane, which in practical terms means software that decides which enterprise telemetry is worth collecting, enriching, and routing to a given system or model, and which is not. The company reports revenue growth above 400% year over year and no customer churn. The commercial logic is straightforward. Organizations pointing AI systems at their own operational data are discovering that most of that data is expensive and useless.
Agents moved into regulated work.
Encore AI, which until this week operated as Insight.io, raised a $30 million Series A led by Team 8, with Planven and The Garage participating. The company works in regulated industries, chiefly financial services, and its approach is unusual. Rather than training agents on generic support transcripts, it studies the behavior of a client's highest-performing human representatives, extracts the specific actions those people take, and builds agents that reproduce them across voice, chat, and web forms. The stated goal is revenue rather than deflection, recovering balances, completing applications, converting leads. That is a narrower claim than most agent companies make, and a considerably easier one to measure.
Reporting agents arrived as well.
Workiva introduced 3 specialized AI agents Wednesday, along with an intelligence layer the company calls Workiva Knowledge, grounded in each customer's own documents and instructions. The first agent automates consistency checks across financial reports. The second reviews peer quarterly and annual filings to surface disclosure gaps. The third drafts and scores sustainability disclosures against European and international reporting standards. All 3 produce traceable audit trails. That last detail is the reason this matters. Financial reporting and sustainability disclosure are domains where an unexplainable answer is worthless regardless of accuracy, because the work has to survive review by an auditor. Traceability, not capability, is the constraint these products are built around.
Hospital supply chains followed.
Genesis Automation Healthcare opened an agentic AI design partner program Wednesday, following a demonstration at the annual Healthcare Supply Chain Conference. The system it showed identifies cost savings across hospital surgical supply chains, comparing what a given procedure consumes against what it actually requires, and flagging the difference. Surgical supplies are among the largest controllable expenses a hospital carries, and the variation between 2 surgeons performing identical procedures is frequently substantial and rarely examined. A design partner program means the company is recruiting hospitals to build alongside it rather than selling a finished product. In healthcare operations, that is usually a sign the workflow questions are harder than the modeling ones.
A browser bet on knowledge work.
Polar raised $5.7 million in seed funding Wednesday, led by Madrona, with angel investment from former GitHub chief executive Thomas Dohmke, among others. The company was founded by Kevin Zhang, who worked on Comet at Perplexity, along with 2 colleagues. Polar is building a browser, but not for search or summaries. It is built to run long stretches of routine browser work with minimal supervision, aimed specifically at knowledge workers rather than general consumers. The first generation of AI browsers competed for the everyday web user and largely failed to displace habit. Polar's wager is that the durable market is the person whose entire job lives inside the browser.
Security closed out the day.
And ThreatLocker closed a $190 million Series F on Wednesday, led by Elephant, with D.E. Shaw Ventures, Arthur Ventures, and Koch Disruptive Technologies participating. The Florida company sells zero-trust endpoint controls, software that permits only explicitly approved applications to execute. That model has taken on new relevance this month. After a series of incidents involving autonomous agents acquiring credentials and reaching systems they were never authorized to touch, the question of what a piece of software is permitted to do, as distinct from who is running it, has moved to the center of enterprise security budgets. The Capitol is following that shift.
That's your briefing for Thursday, July 30th, 2026. For DX Today, stay curious.